This is an RNZ podcast.
Hello and welcome to this episode of Your Money with me, Mary Holm. Thanks for taking just a few minutes to listen in while Jessie Mulligan and I talk through some useful ideas about how to make your money work better for you. Just remember though, this is guidance. Final decisions are up to you. Over to Jessie.
Let's go to personal finance expert Mary Holm, who's in the building. Hello.
Hello, Jessie.
What a great topic this week.
Yeah, look, it's interesting. People get into investments without sometimes giving much thought to getting back out of them again.
Yeah.
I think they picture that their, 1,000's going to turn into 100,000 or whatever they're dreaming of, but they don't sometimes give much thought as to how they can get it out again. And with some investments, it's perfectly easy, and with others, it's very difficult.
I'm immediately thinking of like shared family batches.
Oh, yeah.
Or family businesses.
Yeah, those are really good examples of extremely difficult stuff. And you see, I know of couples who have run a business and then they try to separate to divorce and, they kind of can't in some ways because otherwise the whole business would fall down. So they just don't live together or whatever. But we're not really so much talking about those ones today, but what got me thinking about this whole thing actually was 4 weeks ago, my second to last session, you were actually away and Wallace Chapman was running it, and I was talking about answering a listener's question about the stock market, and he was saying then basically what is the point of the stock market or share market, in that a company, they issue shares initially in an initial public offering and people buy those shares and the company gets the money, but then after that you go onto the stock market and sell your shares to me and I sell them to you.
What does the company get out of it?
Yeah, what does the company get out of it? And I gave what I thought was a reasonable answer to that. I said, talked about shareholders being the actual owners of the company, and that the executive's job is to increase the value of the shares for the owners, i.e. the shareholders.
That's a great answer, yeah. I wouldn't have got there.
But then a listener sent in a really good email that you might like to read out that I thought answered the question much better than I did, and it gets to the point about getting out of investments.
Here it comes. Once a company has sold shares in an IPO, they
not
that one.
Sorry, Jessie. That was, I kind of just summarised that. That was what the guy said 4 weeks ago.
Yes,
so we're going down to...
So here's that one. Mary Holm's response to the first question was confusing, to say the least. That's a bit unnecessary.
Yeah. Oh, a bit mean, yeah. But
You always get a bit of that.
Yeah.
One part of the question was, in effect, what's in it for the company when its shares are sold by one person and bought by another? And the answer is simple. In the short term, nothing. In fact, maintaining an ever-changing share register is an expense the company could do without. But the longer-term view is different. Investors' needs continually change. They need to be able to buy shares when they have funds to invest and sell them when they need the funds for some other purpose. These needs are enabled by an active share market. If there were no share market, in other words, if investors were unable to pass shares on to someone else when the need arose, they wouldn't buy shares from an issuing company in the first place. And needless to say, if no one would buy its shares, a company wouldn't be able to raise funds. In short, while the mass of daily share transactions between individual investors is of no immediate benefit to a company, it's the existence of the market in which these transactions take place that enables the company to raise funds when required. I like that from Brian Smith.
Yes, yeah, it's a very good letter, and he thought it through in a different way from the way I did, and a better way. In other words, the share market's there because people would be very reluctant to buy shares in the first place when the company first issues them, if there wasn't a way for them to get out when they wanted to, and so publicly listed shares, in other words, shares that are listed on the stock exchange, are pretty easy to get out of. Not, some of the smaller ones, you can't necessarily sell today, you might find it takes a few days before this buyer comes in and wants them at a price you're willing to accept.
Yeah.
But it's only a matter of days before people can sell publicly listed shares. But then you get on to shares that are not listed on the stock exchange, and we've got another email from another listener about that. It's quite interesting.
My current problem, this listener says, is being able to sell my $60,000 odd investment in shares that I own in Pledge Me. Despite numerous emails to various people in the company, no one's really interested in managing these shareholder concerns or issues. My 2,100 shares would be worth, according to their last lot of fundraising by sale of more Pledge Me shares, considerably over $200,000, and I'm wanting to sell mine at half that value. Any suggestions as to the company's obligations to provide a marketplace for sale and purchase of its shares would be most welcome, Gina. And this would apply, I think, to anyone who'd seen one of those crowdfunding company share offers and thought, I like this company, I'll put a bit of money into that. They're going to grow. And then you don't really think of, like, even if it does grow, how you would get your money back.
Get your money back, yes. Just to make it clear to people, Pledge Me is a crowdfunding company, but this is not investing in one of the crowds that wants to be funded. It's investing in Pledge Me itself.
It's a bit confusing, isn't it? It's a bit meta.
Well, it could be. Yes, it could be a bit confusing. Yeah. But so, and Pledge Me is not at this point listed on the stock exchange, and so it's not as easy to get out of. So I forwarded Gina's email to Pledge Me to get their response on it, and they came back with a big long answer, which I summarise. They immediately knew who we were talking about, even though I didn't give them her name, because they said, yes, we've had this one person trying to sell shares, and pointed out that she's got a big holding in the company. She owns 4.4% of the whole company, so she's not just a little dabbler in there. And when she says her shares would be worth considerably over 200,000, they're agreeing, yes, quite possibly quite a lot more than that if she can find a buyer. But they say, I said to them, well, did you tell people when they were going in and buying these shares that they might not be that easy to sell again? And they said they've had issued three lots of shares, each at quite a lot and bigger price each time, actually, as the company's done well. They issued a risk warning each time, which included this language: you may lose your entire investment and must be in a position to bear this risk without undue hardship. Which, of course, hasn't happened at this point. It's gone the opposite way. It's done very well. And they say that this offer is not a sort of widespread offer, and there aren't as many legal protections as there are for some investments. They go on to say that the board doesn't have a predetermined view on how or if we will exit, which I assume means the members of the board, how they'll exit or sell their shares. In that first offer, I don't know that they spelled it out clearly enough, but in the second one, which I gather Gina was also involved in, they had an extra statement which was, as we don't have a secondary market. Now, let me just stop here and say a secondary market is... A primary market is when a company issues shares and people buy them. Yep. The secondary market is when the people who buy the shares sell it to other people, like a stock. The stock market is a secondary market, or any other market where it's not the initial company selling or the initial investment selling. It's passing on from A to B out there amongst the public. So Pledge Me says, as we don't have a secondary market, your shares will not be liquid. That means not easily sold. If shareholders want to buy or sell shares, you can register your interest with us, and we can manage the buying and selling of shares if there's an interest. And then they've gone on to say that they have tried to find people to buy Gina's shares, and they've, in fact, found a couple of people who are interested and forwarded that information to her and said to her, look, you might want to sell in smaller lots rather than selling the whole lot in one block, because it's a big block. People aren't necessarily going to want to come up with...
Wandering around with $200,000 in their pocket.
That's right, exactly, yes. So that's really basically their answer. I mean, I think they probably should have been a bit clearer in their very first offering. It sounds, I think, as though in the very first offer they weren't quite so clear as they were in the second one, and she took part in both. She might not have read the thing quite so closely the second time around. But look, there she goes. She has got a way of getting out. She can keep working with the people at Pledge Me, and they will keep on. They apparently are telling other shareholders, hey, if you want to buy more shares, we've got a seller available. And they might, after this broadcast, maybe other people listening will think, God, I'd like to go and buy some of those. And they could probably just ring up Pledge Me and say, is it possible for you to get me in touch with Gina? Which could happen.
Particularly if she's only asking half the market value.
Yes.
It'd be pretty hard to work out what the market value was.
Yeah. Yes. Look, I'm not sure how they do that. And I do just want to quickly say that she's done very well with her investment, but this is high risk stuff. And so, if anyone who's listening who thinks I want to get on that bandwagon, you could end up with very little.
Mary is, as you know if you're a regular listener, she's keen on shares, but she always says don't get into shares unless you either have enough money to get a diverse range of different shares, different industries, different companies, or you're going to buy one of these index funds units where for $1 you get a good mix of everything. Am I summarising your position?
And absolutely, and you must have 10-year horizon. I understand that Gina's bought the shares and wants out just a few years later, and that's a short term for a shareholding.
Yeah.
These sort of small growing companies really want people to be committed for 10 or 20 years, really, is the ideal way of doing it for both sides.
Ideally for Gina, some multinational would swoop in and buy the whole lot, right?
That's right. And who knows what might happen out there. But
so that's shares.
Yes.
And now let's go to some other sort of, what's the word I'm looking for? Other segments, sectors?
Yes, other types of investments.
John says, I have an investment in a private consortium that's... Oh, so we're going to discuss these other ones first, aren't we?
Well, we could do John now, if you like.
Okay.
Yeah.
I've got an investment in a private consortium that owns a property in Christchurch for lease. Unfortunately, the original tenants for whom the property was constructed went bankrupt, and since then the investment has failed to provide any return. The shareholders were asked to provide additional capital over a year ago to prevent the bankers who have a loan to the company from forcing a sale. This is over a year ago and still no return. I'd like to withdraw my capital from this disastrous investment and would value Mary's advice.
Oh, I don't know. I mean, a few of the people that have written, and I think they were kind of hoping I would say, hey, here's a fairy godmother who's going to get you out of trouble, and that's not necessarily true. But what John's talking about is some kind of a property syndicate or a property investment where often it's just the single property, a commercial property, and quite a few different people put money in and buy the property together. A couple of notable points about what he says in his letter. The property was built for a particular tenant, and that tenant, it could have been a retail shop or a factory or who knows what, has gone bankrupt. And you want to be really wary of getting into buying a share in a property that's built for one particular tenant, because they, if they don't do well, sometimes.
I just immediately thought of those Pizza Huts, those old Pizza Huts, with the roof shaped.
Yes.
Can't be used for anything else.
Yeah, and the sort of dead petrol stations you see around the country,
right.
They look very much like dead petrol stations here. And another point about his letter, he talks about how they asked for additional capital from the investors, and that's not an uncommon thing in these investments. People put in an initial amount and they're not obliged to put in any more. But down the track, the people running it come back to them and say, look, things aren't going so well and the bank's knocking on the door and we could fold here.
That's worse than a bad investment, isn't it? Having to put more money into it.
Yes, but good money after bad, quite possibly. You've all got to put in another, 10,000 or whatever it is. Or the whole thing is going to collapse. And that is the kind of thing that can sometimes happen in these investments. So I talked to the Financial Markets Authority about these sort of property investments, and some of the older ones, and I don't know how long ago John's one was set up, there's different ways they've been put together. In more recent years, they're either equity office or management managed investment schemes. Now, don't worry about that. That's all a bit confusing. The key point here is that they have to issue what's called a product disclosure statement, or a PDS, at the beginning when they first start. It used to be called a prospectus, and it sort of gives all the basic information about the investment. And by law, that has to include information on how you can get out of the investment. And it also has to include a key risk section telling you how risky things are. And one of the risks typically in this sort of investment will be it's not that easy to get out of it. What I suggest John does is looks either on the website, if the property investment's got a website of its own, or if not, or it's not a good website, go onto a website called Disclose, DISCLOSE, government-run website, which has got a whole lot of information about a whole huge number of financial type products and services. And on there will be the documents, including the product disclosure statement, or PDS, and that should be telling him how he might be able to get his money out. And then he'll no doubt have to contact the firm itself, and if that's not working, he can go to the FMA. And a lot of people, the Financial Markets Authority, the FMA, certainly can't always get people's money back. Sometimes it will just come back to you and say, no, look, we don't even regulate that particular type of investment, but quite often they do, and they can, at least maybe steer you in the right direction. It's worth a try. Just speaking more generally, quite a lot of investments have disputes resolution schemes, and if you can't get your money out, on the disclosed register, it'll tell whether they've got a disputes resolution scheme and who that is, and that's free to you to go there, and they can listen to your side of the story and possibly help you. None of these ways guarantee you'll get your money back.
No, it's really an investment that could have gone south, has gone south. Really.
Yes.
It doesn't really sound like
It doesn't sound. No, one thought that struck me in reading his email is, even if they can find a buyer, it's quite possible the buyers aren't going to want to pay very much for it, because if there's no tenant there at the moment, there's no money coming out of it. It might be worth very little at the moment. He might be better off holding on in the hope that maybe they do get a tenant at some point. It's hard to know. I'm advising here in a bit of a, in the dark really. But moving on just quickly to other types of investments like rental property.
Yeah, we just got 1 or 2 minutes left.
Have we? Yes. Okay, so we better go quickly through here. Rental property is obviously one that is not easy to get out of in a hurry. It might be, if you're lucky and the market's booming, you might be able to sell it straight away at a nice profit. But please be aware, and I think people around Auckland are getting more and more aware now, that if they want to sell it, in particular, if they want to sell it not too low a price, it might take quite a long time to sell, and you really should be aware of that when you get into that sort of investment.
Yeah.
Bonds you can sell on a listed market, a bit like the share market, but it might be for less or more than what you paid for initially. A couple of other just key points here are that a very basic point that I've often made before is the importance of not being forced to sell an investment. So before you get into an investment, it's a really good idea to think through the worst case scenario. If you lose your income in some form, your job or some other form of income, would you manage? And if not, would you be forced to sell? And if that's a possibility, it's not a good idea to get into an investment, because it's when people are forced to sell that very often they have to accept a much lower price than they wanted to. And what's more, if they've borrowed for the investment, such as getting a mortgage for a rental property, they can sometimes end up selling for less than the mortgage, and so they've got no property and a debt to the bank. So you've really got to think through all this stuff before you get into any of these investments. Look at how to get out, how much it'll cost you to get out, the brokerage fees, the commissions, all of that. Think ahead a few steps before you get all starry-eyed.
But don't let that put you off investing money.
Indeed, yes. People are either too scared or not scared enough. And I'm talking to the not scared enough ones. Yeah,
Great, love it.
Yes.
Mary Holm, thanks.
Pleasure, Jesse.
You can listen to Mary's advice as a podcast by heading to the RNZ website and following your nose. Head to the podcasts page, and she does a different topic every 2 weeks. So no matter what your financial situation or stage of life, she'll definitely have something for you.